behavior. But now that's looking at this example about how you're going to use a future market, use a future instrument to hedge this bond. So remember we say when you're hedging is always take upside position. If you short something, then you should long to hedge it. If you have the bond, that means you long the bond, then you should short the future, the derivative. Remember, you have to use something to hedge it. So use another derivative, right? So in this case here is we have the bond. We're holding this bond means we have it. That means we long this bond already. So the bond is a $5 million face value bond. But remember, when you calculate it, you just use 1,000 and multiply, we have 5,000 of this bond. But the bond, that's why we code as 1,000 as par. So that's easy. You're dealing with 1,000 and then multiply 5,000 is 5 million, right? So you can do that way. But just follow me. I say, okay, this bond right now worth 5 million. Okay. And this is, like I said, is the beginning. It is 6S means 6 coupon bond. That's how the bond code in normal, how they say that. They say 6S means 6% coupon bond. Okay, and this means maturity day. So 2030 is maturity. Okay, so this is bond price and the bond was the coupon rate and was the maturity. Okay, and then assuming right now we are at March 2013, assuming today is March 2013. Okay, and this bond, of course, if mature at 2030, that means this bond have 17 years to go. Okay. So this is a bond right now. So our long-term bond is 17 years mature, right? So to be delivered in Chicago, commodity market, future market, the contract, the future contract is expired in 1 year. So you wanted to get in the future market. Remember we talked about future market, right? So you just buy 1 year maturity that contract. So just 1 year. So then you buy is maturity choose March 2014. So this is bond future, okay? So this is bond future. Then you're gonna be buy mature at the 2014. So today, so you is 13. So you have 1 year. You just hedge 1 year, okay? We'll see. So that's the story. Like I said, line by line. So far, you're okay. Just follow me. If you don't understand any line, and stop me. I repeat it again because then you will finish this. You will understand the story. Okay. And then we go back again. Okay. Because when you see the bigger picture, and come back again. Okay. But at least right now, line by line, you understand what we say. Okay. So you have the bond. But then you buy you buy the bond. So then you have the future contract. You want to get it in 1 year. But remember we say you have the bond, so you should short, right? Take upside position, so short, let's see. So interest is expected to stay at 6%, so which is good, means life is so easy. Right now, assuming interest rate right now is 6%, and coupon rate, it is 6%. So now tell you the bond is selling at a par at this moment when you get in the future contract, okay? So that's at the par. For next year, so the 6% coupon bond and the future contract are selling at a par. Okay, that's exactly what I said. Okay, so bond selling at a par because interest rate right now in the market is 6%, and the bond coupon 6%. So bond it is selling at par. Okay, so the future contract right now selling at a par. All right. So now continue going on. So needed to offset, like I say, right? The offset the long position. So you should short. So your direction, you should short. So in the bond with a short position, okay? Because you have the bond, so that means you're long already. So that's why you need to offset the long position. You just short. So your action is short, okay? So short at the par, okay? Because part of the future is selling at the par. So you short it right now. So shorting at the par position. Okay, so that's good. We know everything in the position right now. We have the bond, we short already, 1 year contract, short at the par. Okay, now see market what happened, all right, market moving. So if interest rate increased, all right, increase over the next year from 6% to 8%. Okay, so at least we know the bond price will be going up or going down.
Going down.
Going down. Very good. Bond will drop. Okay. So very good. So before is 5 million, bond price will be lower than 5 million. Okay. So they already right now it's not a point how to calculate bond. We know how to calculate bond. We right now just take care of the direction. Okay. So because the 5 million before, but interest is going up, so now bond drop below 5 million. So now they already calculate for you, say it is 4 million, okay, around there. So just this price, right? So if you're curious, you have the exact number, you go calculate it, just use 1,000, then multiply 5,000 bond over this bond, you will get this price, okay? You calculate it. So just take it, okay? So bond dropped. Because you have 5 million, right now become 4 million, okay? So that's why you lost 960, so basically around 1 million, okay? If you don't hedge, you don't do nothing, interest going up, you lost $960,000, okay? So from here to here, you'll be okay, right? Just tell you, say you lost if you don't hedge it right now, you will lose the money if interest is going up. We okay on this page? We're good, right?
Yes.
Good.
Yes.
Very good. So now we go next one because I haven't hedging yet. Let's do hedging. Okay. So let's see. So because you short that piece, you short it at 5 million. Remember at the par, right? So at 5 million, so short purchasing in the future. Okay, contract value. Because right now the market, the bond is value at 4 million. But you short at 5 million means you're selling at 5 million. Okay, then say it again. You're selling 5 million, but now trading at 4 million, but you shorted. So the difference is you make it 960,000. Are you okay for this piece? Your gain is 960,000. You okay so far?
Yes.
Good. So let me repeat again, okay? You short is short at 5 million at the par, but interest going up, the bond price dropped. So you short at 5 million. So that means when you closing contract expired, the difference is you make the money. That's why you make this much. Okay, good. You make money on your hedging that piece, but you lose money on your bond. You lose. So this two added together is your position. You lose nothing. You lose this much money, okay? But the hedging make money this much. So end up, you still have 5 million intact. That's what is hedging. You didn't make money, but you didn't lose money. That's hedging, okay? Let me ask you, since we're here. Remember we say interest is going down from 6% to 8%. But we also assuming we hedged it already. So now let's say again, what if interest rate from 6% going down to 4%? You don't need to bother about number. Just tell me the direction. So you have the bond, $5 million bond at the par, but the interest is going down, dropped from 6% to 4%. What happened to your bond value, 5 million?
It goes up.
Goes up, very good. So your bond going up, right? So you will be so happy, say, if you didn't hedge, you just have, let's say go to from 5 million to 6 million, you make 1 million, but you hedge it. So you short at 5 million. But right now, because interest is going down, the bond price is going up to 6 million, for example. You short at 5 million, but the bond price go to 6 million. You lost 1 million. You agree? From your short that one, you lose 1 million, yes or no?
Yes.
Good. You lose 1 million, but you make 1 million here. So therefore, you still have 5 million intact. You protected. But you didn't make money. Remember here showing you didn't make money, right? If you don't hedge, how nice, you make 1 million. But the whole point is hedging is not for you make money. That's the whole point, tell you eliminate risk, eliminate loss, but didn't gain. See, otherwise you will gain 1 million, so you will have total have 6 million now if you don't hedging. Colin, you have a question? Go ahead.
Oh yes. So I was gonna ask. So if the price goes up to 6 million or 7 million, and can I resell it in the futures market before the expiration date?
what do you say? You already hedged it, right? So you know your bond make money, right? But you this leg, you lose money. So what do you want to do?
So yeah, like before the expiration date for of the futures contract, can I also
Yeah, you
sell
can.
it- sell
Yeah,
it?
you can close your contract, but you already lost, right? Let's say this way. Okay, you're not expired, but you lost. Why you close? You close when you lost. What if next day, next month come back again? You still have a maturity period of time. You do not know. You cannot time in the market. And plus, normally people hedging have purpose. This 1 year have some purpose, right? So you meet over that, then you really speculation. If speculation, why you hedging, right? Just speculate like this one. If going down, you make money. That's how speculation is. You're betting on a direction. You don't hedging. But if you hedging, why you leave early? Let's say you lose already. Why you leave? You make money, you just walk out. Maybe okay. You can close it. You can always buy. Like I said, you short this bond, right? The future, you can close it. You can close, but you lose already, right? The interest rate already going down, and you're shorted. So that's it's a free market. You can always, yeah, future you can close it. You can close before that, like options. We'll talk options more soon. But anyway, let me go back again. Okay, we did both direction. Okay, we did interest going up. We did the interest rate going down. Okay, interest going up is writing these two slides. Okay, let me repeat again. This is the one interest going up. This bond you lose value. You lose this much because your beginning you have 5 million. Right now become 4 million. So you lose it. Okay, in your bond. If you don't hedge it, you lose money. But you did hedge it. So that's a good thing. You hedge it, but you short it at 5 million. In the beginning, you get this, remember, take a position. It is take offside position. So you choose the short, the future. But future, that moment short at a par. Remember that moment interest rate is 6%. But then interest is going up to 8%. So the value dropped. Dropped is okay. You are still short at 5 million. So then you make money from your short. And that's why you make the money exactly equal to your lose money. So you still maintain the 5 million bond value. So that's the whole point in the hedging, right? So then we did this. Then we also make a hypothetical say, what if interest rate going down, dropped? So if interest dropped from 6% to 4%, this bond value will be going up. Definitely will about 5 million because interest rate going down, bond price will going up. So I say that assuming up to 6 million. So you make 1 million from this bond. Unfortunately, you hedge it. So hedging costs you here too. So that means you from 5 million, you're short, but right now worth 6 million. So you lose 1 million from your short leg, okay? This lose 1 million, but you make 1 million here. So same thing, net out. So that means it doesn't matter which interest rate direction movement, you definitely maintain 5 million. That's how your hedging is, right? Intact on this 5 million for this 1 year. After 1 year, if you go ahead.
I just wanted to ask, is this a binding agreement?
What do you mean? No. What do you mean binding? Yeah, no.
So let's say I'm the one holding the $5 million in bonds,
Right.
and then I say I want to short it for next year for March 2014, but then I see that the interest rate went down and the value of it went up. Now I don't want to sell it. Or sorry, the other way around. The interest rate went up.
You can close it. Okay, now you can do, it's not binding. You can do whatever you want. It's a free market. Okay, let's say you beginning you short, and then you change your mind. You short, then you buy. Same contract. Let's say in the middle of let's say March 2013, you did this interest, this 1 year maturity contract. But let's say at June 2013, that month, you change your mind, okay? So at that moment on June 2013, that moment you have a half a month, 9 months left. You short this contract, you buy this maturity contract. You buy March 2014, that contract, but you have 9 months left. You buy it and then close it. You understand what I'm saying?
Yeah, but so if in this situation, let's say I'm the buyer now, why would anyone buy a bond for $4 million that's worth 5.
Huh? What are you talking about? No, bond right now trading at this price. Why? Because interest is going up, bond trading this one, right?
Right. So why would I pay 5 million for it?
What do you mean you pay 5 million for your bond is here, drop to 4 million now? What do you mean?
So the buyer would pay 4 million or 5 million for it?
Buyer buy at a market price. This is market price, right? So bond before worth 5 million. Right now, interest is going up, bond worth that much. So if anybody buy, will buy this price, right? This is market price, right? But this is your bond, you lose, right? You from 5 million drop to 4 million. If I buy your bond, I pay this much, you lose, right? That's why you're hedging.
But on the next, on the next slide, it says the buyer of the futures contract agreed to pay your 5 million.
Right, because you're short. Yes, because you're short at 5 million. Let's say you're short this contract at 5 million. I long this contract, right? So I am the buyer of this contract. That's why I had to pay you 5 million. You think who pay you? I pay you. The other guy pay you, right?
Okay.
You short 5 million, right? You sold a 5 million contract. So you short is the bond. So you have right to sell it at 5 million. Remember, you're selling it. But the other guy is me who, in the beginning, I long, you short. That's how market is. Always have the other guy. So I long this contract. So I lose. I had to pay you 5 million because this is a market, right? I committed. I have to pay you 5 million. So I lose.
Right. So that's what I'm saying. So whoever committed to pay 5 million will lose.
Yes,
and they can't back out. They can't say, oh no, I don't want to buy it.
No. This is the market. You can't. Remember, you lose money. Let's say me, I trade with you. You shorted, you make money. I lose because I long this future. You short this future, right?
Right.
So I cannot say walk away. This is market. What happened? Remember, you have margin call, you have margin requirement. How I can walk away in my account? I lose money already, and my margin call already monitor. Remember, this market take care of it. So market will margin call on me. Market will follow me, and I already put on the margin there. So a lot of things they take care for me. They take care of my problem. You don't need to worry. Market take care of you. So it's me. I have to pay. You said, oh, I said if I lose money, I said, oh, I'm walk away. I'm not gonna pay. I'm disappeared. But this market, everybody want that way. You lose money, I'm gone. You can, right? That's why we cannot do it. So that's why you're committed. You have to, you broker there too. Okay, your broker will selling your account. Remember, we said margin call. If you learn that margin call, your broker just take care of it, selling everything. If you don't give, you're against the margin call situation. Yeah, that's another person. You don't need to worry the other person. You just worry your own. Did you hedge it? Yes, you hedge it. So that's perfect. Yes. Yeah,
okay,
the other
thank
buyer. You. Yeah, you're welcome. Buyers and the other person. But market, derivative market always is zero-sum game. Always. Somebody make money, somebody lose money because either somebody hedging or somebody betting on direction. So always have the other leg. Okay, always, yeah.
If you're down that much amount of money, let's say it went the opposite way, could you let the contract expire worthless? Or not?
Well, this is the future market, okay? You lose money. In this case, for example, let's say me, I long this future contract. I lose money, right? I lose it. I can close it, but even I close it, I long this future contract. If I close it, I selling, I close upside my position. But somebody have to be there, right? Because I close it, still this contract have 9 months to go. If I close it at 3 months, somebody will get in again, have 9 months left.
Oh, so someone takes your spot?
Yeah. This is the market. Oh, wow. Yeah, somebody take my spot, maybe like the entry level, just like this, okay? You have 5 million right now market to selling 4 million. To you, it's lose money. I maybe want to buy. I'm happy because it's cheaper now. And then tomorrow maybe go to the 4.5 million and make money. But to use 5 million, you lose money. You can see that, right? Market can be anybody, any condition. To you, maybe lose, to me, it's a gain. See, look, for this law, now interest going up, price going down. More people will come in to buy, right? So same logic. Doesn't matter what you're hedging or not hedging. You can get out whatever you want. Like this one, you can get out if you take an upside position, just out. but then somebody else will come in. You never know who that person come in. Maybe they want to hide their position at that moment in time. So that's the market. It's bigger market, better, because so many people, so many purposes, very, very liquid. Okay, liquidity will be there. Okay, it's okay so far? Okay, so the whole point I give you summary is you have the bond and the price going down, how you hedge it. Then the other way is around the same thing. Okay, we did this one, right? So that's the example about the hedging. But many hedging, just same thing like that. Do the either way, you don't have any trouble. But you don't make money, you don't lose money. That's how hedging is. You saw it, right? You don't lose this 5 million bond value. But you don't make money. If interest is going down, you suppose make money on the bond value go to 6 million, but you didn't make 6 million because you hedge it. Hedge costs you there. So that's, you didn't speculation, but you do protect the 5 million. That's how hedging is. So hedging is a limited risk, but it is not really for your speculation, make a profit, okay? So, all right, so now let's go to next level. For finish the hedging, we finish the what mean of that and the future market, how we use that. We did that, very good, very good. We moving to some other situation, right? So tell you see, you worry about a future market. Future market is very good market. It's organized exchange. What do you mean organized? It means even the price, like I told you, is that Apple, if grade 1, grade 2, grade 3, they graded, they organized and tell you this quality was the price, that quality was the price, this size was the price. The exchange settle, tell people, make a very good organized everything, okay? So that's even the price, you see the option future market, the options, the distance, depend on what's the penny stock or not penny stock, the price distance, they organize, they arrange those things, okay? So very good organized exchange, big market. So you don't know the other guy. Like I say, you short the bond future, I long the future. You do not know me. It's just another person in this market. It can be anybody, okay? So very well, good organized. They are label of quality and distance and the pricing, everything's organized very well, okay? So they are regulated by commodity future market, okay? So that's regulators. Each market have their own lot of regulators because they make sure they're doing well and protect the market, okay? So that's what they do. They ensure price and not manipulated. So if somebody manipulated, they can chasing it because they have record, okay? Can see who is $1 million trading on that way, or information linked. Somebody have inside trading, all they can see it. So market is very efficient right now. Can tell those record. Any minute, any second you move, you can see it, the record. Okay. So register. Auditor, of course, there too. So, and we have broker dealers, yes, brokers and traders, they're all there. So that means a lot of people in this big, huge market, and they are all registered, have this kind of a professional way. Like I said, you have broker account, they are becoming level 1, level 2 broker. Broker have, certain levels depend on, like you said, discount broker. That's another level, right? So many the market very good overnight. Okay, so propose the future contract to ensure they serve the public interest. So if anything you want to put in new, like right now they have Bitcoin will become out of the ETF. Many things you have to get approved before you can get in that market. Okay, so it's not protect the public. That normally it take time. You organize, you apply and get the approval, because not everybody say I want to do it, and then that's why market is doing well. Okay, so like I say, it's huge international. A lot of people from overseas, from other countries trading our market too. The derivative market, future market, because it has so many, not just commodity. You have currencies, you have treasuries, you have treasuries futures. Many global banks doing that, trading that. So becoming very popular 24/7 market, very popular. Okay. So when you're trading it, they have a size, contract size, okay? So that's why if you want to buy, like you just saw the 5 million bond, but normally have side basic one and then what it is. For example, if you're trading S&P 500 index, you cannot settle as say you give me the index. You can't. It's based on this rule. It's a calculation, right? Index multiply 250. So then they become, this is what your size of your paying, okay, based on this calculation. So that's each one has size. For example, let's see what's the, so this is the 30 days of, Fed fund is 5 million. Okay, that's the size. You cannot trade like it. That's why you and me never trade this Fed fund rate, right? Because we cannot reach this level. So that's why normally it's the institutions doing this size so big. All right, this is currency. You can see how big it is. So that's how mark beyond. This is just will give you an idea about when you're trading on the future market. You need to know, like you buy corn, you buy the apple, what's the size? They don't sell in one apple, two apple. They're selling bunch of that. So that's why it's market, right? It is have the contract size treating it. Okay. So
Professor,
success.
I have a question.
Go ahead.
Could you go back to the last slide? What does the right column mean when it says open interest May 2011? What is that rate?
This one, you open interest, that's what it means?
Yeah, what does that mean?
Okay, means the contract is opening. That's open interest means, for example, how many long this future, how many short of the
So it's like the
future.
volume.
Volume is per day, how many move. Actually, this is beyond the volumes. This is just your volume normally say, okay, today we're trading volumes, we have a 500 contract, right, trading. But if it's open interest, means since this contract started to now, still have like the first one, still have 740,000 open interest, means position opening, haven't closed yet. You understand what I mean? That's what I mean, open interest. You got it? So that means the contract is still open, haven't closed. It means some people, like you say, oh, what about middle of the contract, a couple of months, I want to close it. So you can close it. When you close it, the contract size, the years will be open interest will be dropped a little bit, right? And so that's why you can see this number. Let's tell you how many these positions opening. Once they close, they moving, every day can close couple, whatever. So can showing people the size, how the movement of this open interest, how many people have this long contract, have short contract. That's what I mean, position opening, okay? It's good. So we'll see the options, we'll see that too, okay? So let's tell you successful. Remember we talk about forward agreement, talk about those, you will learn more like interest swap, those things. Those are agreement. It's not, it's subjected, counterparty risk, and subject to default, but this is not. That's why it's successful, because future market is, you just saw it global. First of all, very liquid, a lot of people there, okay? And also very standardized. It means that they organize very well, and the margin requirement, okay? And so this all things doing a very good job. So that's why you never heard of even market crash. You never heard about the future market had trouble. You don't, because they did a good job. So that's why they say, okay, deliver, okay? See, we talk about this bond, so you're gonna deliver too, if you didn't close your position. If it's just for hedge purpose, at the end of last day, you should close it, okay? Before market close. Let's say this Friday is your future contract closing day. You have to close it. Or if you don't close, you really means you wanna deliver. You have to selling it. If you're selling, you have to deliver. But if you are not selling it, if you say you short it, okay, so the other side position, you have to give it. You don't have it. So that's commodity. Let's say choose commodity. This is, like I mentioned about a story regarding to that, is if you really want to buy, let's say ox, right? Cow, whatever, is live cow. So you have to deliver, you're gonna selling it. You have to give the one. If you say I don't have it, I hedge it. Then you have to, at end of the day, before market close, you buy, close it. So that means you offset your position, you close it. Otherwise, they believe you want it, so they deliver to you. They really physically deliver. They tell you will tell them they will be the market will very closely tell you, say New Jersey, which location, and you go there, the farmer there go there, pick up, have 10 quail or 10 whatever is a pig or whatever you need to pick up, they deliver there and they really give to you. So that's what you have to really, you said no, I don't want to, you gotta be before that close it. So that's what is another thing you needed to know. For hygiene purpose, you don't want it, you just for hygiene purpose, but you have to take upside position, close it, okay? Otherwise, they tell you very clear where, what time, what's the product to deliver to you, so that's why deliver date, okay, and deliver quantity, okay, they tell you that's what the future market, because it's commodity, anything there. Future contract can be traded, okay, that's why you can buy, selling, you can do it. Anytime you want to close before that maturity, you can do that, okay. So treasury bond, okay. Treasury bond is very, very popular. People use treasury bond because treasury very liquid and also global. Remember, banking required that must have treasury. You can hold a banking, the commercial bank or depository institutions, they can hold treasury security. Remember, they cannot hold in stock. So that's why the banking, like a JP Morgan, $2 trillion of banking, of course, a lot of billions of treasury there. So then when they need a cash, they do something, they can trading it, okay? So then that's why the future market is very popular in treasury bond. Because so many, our government issue a lot of treasury, a lot of maturities, a lot of treasuries. Any Thursdays, they're going to auctions, a lot of things, okay? You have bill, you have bond, you have notes, anything. So because many people, many banking or global, anybody, even the institution, they can do the future market as a hedging, okay?
Professor,
so because, yeah,
I have a question. Where do you even get, like, when you go to the futures market, like, where do you go? Like,
you just type,
platform?
CBOE.com. You can go there or go to, it's very easy. You just Google the commodity market, you just go to the Chicago Commodity Exchange. It's right there. And then you can open an account even. And then they have future market, they can trading there. Chicago, CBOE, I think you can type in there to go there. Yeah. Okay. Yeah. So because Treasury has so many, okay, so therefore they give this kind of rule. So Treasury bond, any Treasury bond that mature in more than 15 years. So let's say 17 years or 16 years, and it's not callable. Sometimes have bond callable. Okay, we'll talk about callable bonds. Okay, just say nothing, no optionality there. And for 15 years is eligible for delivery. So what that mean? Okay, that mean, like I just mentioned about, there are so many treasuries. Every time they issuing and renew it, expired, issue new one. So a lot of, let's say 15 years of maturity bond. Next year they issue another 15 years maturity. So by the time, sometimes when you wanted to, remember you're trading on the future option, you want to be, offset hedging, then you need to deliver if you didn't, right? So which one I deliver? So many. So that's why they define as so many bond you can deliver. So they define that anyone, if you meet this criteria, you can deliver that bond. Okay, so that's what they're trying to tell you here, because there are so many treasury securities. If you have a 16 maturity year left of the treasury bond or 17, you still can deliver, 15 year that bond. So that's how they tell you. Okay, so that means you have many ways you can choose, because so many. All right, so that's how you, for the treasury, you deliver which one you choose. That's all. Just to tell you this market is huge, and then you can choose meet the criteria the bond. They can deliver which one you want to meet this criteria. Okay, so because you have deliver, like I said, commodity you have deliver, and then you have treasuries, then you have currency, you have many things. So that's why you have to figure out what's the rule of the deliver. Okay, so they doing this one is limit the possibility of cornering markets. Okay, what does that mean, cornering? It's like this: if they don't relax, say any bond, as long as you meet this criteria, 15-year eligible to deliver. Even they don't have this relaxed rule, okay? Now you are Goldman Sachs or JP Morgan bond trader, okay? You can warehousing all this treasury bond. You big corporation, no, then you warehouse it. And now, so if somebody wanted to shorting or buy the future hedging, when the maturity, remember you or have the GameStop that story cornering, because somebody if hold so many, when you want to go to market, you short, right? You go to market buy closing position. There are no bond available, no like GameStop. Same thing, no stock, no share available. So shares keep buy up. You short and then you buy up because then you give it squeeze. That's what you call short squeeze. The same thing here, you're cornering just like that. If Goldman Sachs warehouse all those treasury securities and the market wanted to buy closing the position, they short, they had to buy just a limited number of the bond, then they buy up the price. So then they warehouse that many bonds selling at a high price in the market and they make money. That's what they call cornering. So because this treasury security is so huge market, and then that's why they wanted this market well organized, prevented this cornering bond king there, cornering this situation. So that's why they relax a little bit, say any bond, as long as you meet this criteria. So it means 15 years or above, you can just deliver any 15 years of treasury, that'd be fine. So then in that case, relaxing, Goldman Sachs, unless buying all the treasury market bond, otherwise, how you can do? Goldman Sachs, the whole our government have what? How many billions, trillions bond selling, and then Goldman Sachs less than $1 trillion company, so impossible cornering. That's what it is. The whole point. Okay, so you understand what I mean? Cornering. I think it's the best thing you know. Is the game shop that way. So just a corner the short selling, squeeze them. Okay, that's what I mean. So this is the how they relaxing this rule. Okay. All right. So still tell you the successful, right? So buyer seller make the contract with a clearing house. See, like I say, the treasury, the future market, Chicago Exchange, huge market. Okay. So they are working very well. They have margin requirement. They do the clearings. They are mark to market every day in your account every day, telling you did you short of the did you short of the margin requirement. If you're short of, immediately tell you how much money, which day you needed to come up to. If not, you do know the consequence. Not it is. Margin call will be selling everything you have in account, making you miserable. Okay, and you don't want this selling you your assets. You want to selling at your time. That's the whole point. Is you don't want they do it. So that's why you have to meet the margin requirement. Okay, so this that's why they tell you this market did a good job. Okay, so margin requirement and then mark to market every day. All right. So
Professor,
go ahead.
when you do a margin requirement, is that only when you take out a margin?
No, the margin requirement is when you buy share or you're short, you need to put the money there based on, let's say you have 50, even the margin requirements is 50%. So let's say you are buy $100 shares. So you only need $50, okay? And the other 50, they lend you 50 as a margin, right?
Okay.
So you can do that. And you short that's the option. We'll talk option very soon. And you need to put half the money what you're short reserve there because you're short. But your long options, you don't need a margin at all. Okay, but you're short for those people short because they risk to their market. That's why they're short. We'll talk about option that moment. I mentioned this again about how you do options and the margin requirement. Margin requirement is normally you just put some money there for against the market against you. You're going to have trouble. Normally, broker account maybe 30%, something like that margin. We will talk about that more. But something you need to put the money there before you do anything trade. Okay, that's the thing. Okay. So most future contracts do not result in delivery of the underlying assets on expiration day. So normally they don't because, like I say, if you not want to, I don't want a corn, I don't want a cow, I don't want a steak, for example, whatever. I just want hedging. So that's why most of them people is hedging. It just offset position, close it at the expiration day, not deliver. Unless you're farmer, you really wanted the, or you really want to selling the cow, or your restaurant really want to buy the cow, something from market. I say the farm market, they want selling the cow, so then restaurant want to have it. They have connection. They needed to do that. So that means you have really want a product, so they deliver. Otherwise, most people, majority of the market is for hedging. So that's why you needed to offset position. That's why they say they don't need to deliver, not really deliver. Okay. So okay, so that future market, let me mention, since we will go there anyway, go to options. Future market don't cost you. You don't pay to get in, don't have transaction cost. Very soon you're going to learn options. Option will cost you. We'll talk about why it costs you. But here's the future contract. Transaction cost is nothing. Basically, you don't need to pay, say, $10 per contract to get in the future market. No, you don't need it. You don't have commission fee. You don't need to charge it. But you do charge you your loss or gain, that's direction. But however, don't charge you on the getting in this position. Okay, so that's why reduced transaction cost means you don't have to pay that one. Now see, we touch the options. Okay, so before we touch options, let's see what I can open that. Okay, let's see if we can open that. You can see it. All right, let's see what I can do. So you can go to the Yahoo Finance. Okay, you guys, if you can do that, your computer better than from here to see it, because in June may be difficult. Let me see what I can do it. Okay, Yahoo Finance, I do the Apple. Okay, so do I choose a sign? You can see, what do you see my screen? What do you see my screen?
We can see the option chain for Apple.
Okay, good. Thank you very much. Good. That's it. See, look, I have the option. So this is Apple. Okay. So then you can see this option, call options. This expiration day. You can choose many. See, look how many. Okay, very good. Apple is very popular. Okay, you see, that means this is called LEP options. Okay, means very long term, 2023. Okay. So that's the very some stock don't even have options. This is very liquid. Google, Apple, Google, Amazon, those kind of stock is global playing, right? So this is call option, that's maturity. Okay, and I can see, go here, the put. I will talk about what I mean blue color. Okay, so we'll talk about that very soon. But let's see, go to put. Where's the put? What's that many? Okay, here's the put, I guess. Why didn't show you the put? Where is the put? Okay, but should be there showing you where's the put. Okay, here. Okay, put. All right. So this expiration date. So you have call, you have put, and now since we're here, I want to show you everything. Then we leave. Okay. So here you see this is last price. Remember, this is a strike. We'll talk about this, okay? So first, you have expiration day. I can choose this is the April 16, which is tomorrow, and next week. So they have weekly options, all right? And then so you can see that, and then you have a strike. Strike, you can choose. So right now, already trading at 134. Let's go to see. Why is it blue? Because all those blue one. It is a color blue one here, a whole area. It is a stock already in the money, because the stock trading at 134 something. That's at 134.51. So this is a strike you choose. Today, if you buy at this strike, you pay $2.34. This costs you. This is the option price, okay? And this is strike you choose. Imagine you choose 130. Okay, so already in the money right now, trading at 134 something, but you choose a 130 strike, means you have right buy at 130. Okay, so but you had to pay at this point, you had to pay this price. All right, but tomorrow if you go to 140, you win, because you pay $5. Let's say you pay $5. So you have right by the 130. So total costs you 135, but tomorrow expired. It is trading end is 140. You make $5. just in one day actually. So that's what I mean. We're going to go there, okay? At least you know what I mean here, okay? So you see this is in the money on the blue, and this is the price. This is big in the money because this is strike at $60. Right now it's trading at 130. You see, that's the price of cost you if you get in today. All right. But if you buy out of money, look how cheap it is. So this is one day. This is what I choose. I choose 1 week, next week. Okay, not 1 day. So next week you can see. So 1 week later, so you can see buy cheaper one. So right now, let's say betting on right now trading at 134. If you buy strike at 137, it's cheaper. But you believe next week you're going to 140. By next Friday, you're going to 140. You still make money because you pay 137 and then this $1.34. You're going to buy at 137, but you pay $1.34. If you're selling at 140, you still make $1 something. Okay, so that's you cheaper. Buy here is very cheaper. If you going up, see, you continue very cheap because out of money. Okay, but we talk about it. Don't worry about this. I just show you since we're here. Okay, like I said, you see the maturity and this maturity and the option strike and the price, option price, just fall by that option for this strike you pay. Okay, so this is, and then you have call and the put. So that's the option. Okay, let's continue from here. So option is a contract. Okay, so you have, here's very important, you have a right for you, if you buy it, you have right to buy, like you just did now, to buy that option at 130. Okay, right now trading at 140. You still have right to buy the 130 because you have right to do it because you pay the option premium. You pay the money. You pay the money, get that right. So when we said that, it's the whole thing option different from the futures. Okay, future you don't need to pay. Zero cost you. You don't, but you don't have right to anything. Okay, so here's right. What do I mean right? Right like this. Let's say you buy Broadway show tickets, pay $200. Okay. So you can go there to watch the show because you buy the ticket, pay $200. Oh, I don't go. I'm going to be see my friends, so I cannot go. So you don't go, then your $200 just waste, useless. But you have right to go. Okay. Same thing here. You pay the options. You have right exercise at 130 strike price. Oh, you don't exercise. Don't do anything if you don't make money. But if you make money, it can exercise. All right, so because you have luxury, because you pay, you buy it. Okay, so I will mention more about that. Okay, so here's trying to tell you. Let me draw the chart, maybe better for to understand option again. Okay, so let's do this one. All right, so this is line. Okay, this is stock going that way. All right, so let's choose the strike. Strike, just you choose, you select it. Okay, so that's what I just mentioned. I choose, let's say choose $130 per share strike. Okay, strike normally just use X, or you can say I say X equal to, that's a strike. Okay, you choose, you can choose 120, you can choose one, it's up to you. But you choose in the money, it will be expensive, you know that. But let's say right now trading at 134. Here's the spot price. Means spot means right now what are the trading at? Okay, so let's say right now trading at 134. You just saw it. I just said trading at this price. Okay, but you choose this one. Depending on when you choose, how you choose. But let's say you pay that moment. You choose this option, call option. You choose that moment. Costs you. Let's say costs you $2. Okay, when you buy this option, costs you $2. So negative $2. Okay, so that's it. So because you paid, so that's why you have. So what I mean, so you have right. So this is spot. So you have right. No matter what happened in the stock, you still have right to buy at 130. Let's say whatever. I didn't say maturity. So let's say this is a long time. This will take 1 year. Okay, let's say 1 year. 1 year later, the stock go to this level. Let's say it's 140, 150. Give you happiness. So that's 1 year later, stock trading at 150. You pay $2 per share, but you still have right to buy at 130. No matter what happened to the stock, go to the roof, you still have right to pay, right to buy at 130 in the market. So if like that, you can see If you start trading at 150 by the maturity, you still buy at 130. So the difference is $20 per share. You made it, and subtract you pay this option because you pay $2. So you make $18, okay, that per share. But normally contract size is 100. Contract size in option normally it is 100 shares minimal. So that means that in the beginning you pay $200, right? Because one share you pay is $2 multiplied 100, so that's the $200 you paid. But you make it $20 per share. So $20 per share multiply, you have 100 shares, so you make it $2,000, right? And then subtract 200, you make 1,800. You got it what I'm saying? Even I'm fast, but I can slow down, ask me a question, okay? That's how you buy the call option. That's what I mean, the right. You paid, and that's why you're right to do it, okay? So you're not confusing yet? You okay? I want to draw the line. I don't know. You don't say. Okay, you're good. Good. Okay. So if you look at the call option, it will be like this. Okay. You see? And then you do like this. See? That's your profit profile. Okay. You pay this $2 per share. But then if going upward, you make money. The more up this way, this is profit. Okay. You make a profit. So, all right. Since I'm here, I'm drawing here to see how many of you follow me. Okay. This is strike. So I want to ask you, you pay $2 buy it. Do you know what's your break-even point? You buy this call, pay $2 per share. So break-even means when it start going up to which price?
32,
you're starting.
132.
Thank you. Very good. Okay, very important because in exam.
Extra credit.
You get a credit. You're going to be in exam. This is why in exam. Okay, very good. So it is the 132 is break-even. Okay, because you pay $2, and if the stock go to 132, you're starting to make money. Make a profit, okay? But before, if you're not, but you pay $2, so you have to subtract $2, okay? So that's the call, very good. So since we're here, what about put? Okay, I'm just drawing the same chart that put, so you will know. So compare, learn. So this is the stock, go to that direction. Put it, oh, you do that, okay, so that's fine. Let's see. I'm just drawing the chart first, okay? So put the same thing, okay? Same logic, but put betting on direction going down. Okay, you start going that way, okay? But you betting start going this way because if you start going down, you're gonna make money, okay? If you're going up, you do not lose. You only lose the pay this one. That's the same thing again as what we just mentioned about. Okay, cost you here is $2. That's a put. You also pay $2. Same maturity, and then you pay $2. Okay, cost you the same thing again. So what's your break even? You just said that, Andrew. Okay, so let's say you choose strike. Same thing. It is 130. Okay, very good. Thank you. Yeah, so 130, 128 because one going down to 128 because that means you're starting to make money. All right, because you have right. Okay, put here's the case. Okay, you have right to sell. So even the stock going down, let's say going down to $90. Okay, that's going here. It's $90. The stock drop $90. Okay, but you have to put. So you buy it, pay $2. So you still have right to selling under 130. So that's how you use this options to pay to, you want to hedging, you want speculation, whatever you want, but you do know about when you make money, so this direction here, okay? So that's a call and the put, okay? So I already here, I mentioned that.
Do you, Professor, do you use options yourself?
Everybody use options if you do the finance, right? Because one thing is hedging, one thing is but let me show you something actually. If we're watching, remember I buy the call, I pay, right? But somebody doing this way, okay? Here, let me show you. You always have the other guy, remember? So if you buy, you're betting on stock going upward, you buy, but somebody don't. Somebody's selling it. Somebody's selling like this. This is profit profile for the other person. You see, so this person right away, you $2, you buy the call. This person get you $2 per share and pocket it in their person's account. Okay, so stay there until to mature. If nothing happen, if really stock never go above 130, let's say it's me, I'm short, I'm selling the call. Remember, always have the other guy. If you buy, definitely have the other person selling. You buy the call, must be have the other person selling the call. Okay, that's how this works, the market. Okay, so if you buy the call, you pay $2. I sell in the call, I get you $2, but I cannot touch it. You have a right to exercise. I don't. I have an obligation. If you exercise, I am losing. Okay, so this $2 is mine. So now waiting for maturity. Remember next week. Now, even next week, this stock will never touch it. This is stock by expiration time. That's at 4 o'clock market close next Friday. The stock, no matter how high, but by that moment, go back to 129.9. I make your $2. So it's mine. You understand that? But you can early exercise, okay? If you in money, that's next week, next Wednesday, maturity is Friday, but next Wednesday stock go to 150. You say, I'm not gonna wait. You can do it. You can exercise right away, okay?
Yeah, you can exercise it, but you can always just sell the option as long as somebody else buys it, right?
You can. This is what I do. So let's say stock go to 150. Then next Friday, next Wednesday, okay? You can exercise. You make $20. That's it. All right. But the other guy who you exercise, remember you're not mature yet. But somebody else who take the other side, your exercise means you're long the call, then you close the call. Okay. The other guy take you close the call, and they continue have one more day. One more day, anything can change it. Then maybe go back again. Remember, like I say, maybe go back to below 130. I'm selling this one, make money. Anything can happen, but that depends on when you're betting on, how you're betting on, right? So if you make money like this way, you have a right to exercise early, you can do it. I don't have a right to do anything. I just waiting for material, because that's why I didn't buy, pay it. I actually shorted it. I take this money.
Oh,
Waiting for
Professor,
maturity.
don't you like almost always make more money if you sell the option rather than exercising it?
No, watching, very good. See what happened. Look, I betting on, I selling the call, right? So look, if it start going upward, look at what I lose money. Look, I lose a lot of money. This is very fast, option moving very fast. That's why it's leverage, okay? You gain very fast. You lose. So I betting on stock not going upward. I betting stock will stay or below 130, okay, during this time. Time is very important here, right? So, but if the stock go against me, let's say, I think this month Apple will be make earnings, okay? If I betting this way, I betting down, this Apple really earning sharp, surprise you good, then this person, whoever shorting this one, get killed, right? But this one you can early exercise because they have right. That's what I mean, right? This one don't have right. Don't have right means they cannot early exercise. They had a waiting for, okay? So that's why options, you have to be careful, because otherwise against you, okay? So we mentioned about the strike price, okay? We mentioned about the right. You can buy, you also can sell, right? So that's the options, exercise price, also called strike price, okay? And then you saw you have expiration date, you saw it. They're very important, those things too, okay? So you have seller, like I said, is obligated. Like what I just did, I saw in the call. But same thing again, let me tell you, this market is very, very flexible. You can sell in the call, but you can sell in the put too. You sell in the put, okay? Like this, all right? So that means what I'm betting on. I'm betting this stock. If I sell in the put, I get this $2 in my account. I betting stock will be above 130, all right? Not lower than 130. But I just wanted $2 in my pocket. I betting on just like that way. Okay. So because you here, so once I've been here, I just don't want to go the other screen. Let's continue use this example since you already have some idea what the option is. So let's say this way, okay? Since we already see call and put, okay? So you can do either way. You can say, okay, you pay $2, buy the call, okay? So let's do this. This is what you make a money profile, okay? Just do this way. That's your call profile. So you're going to make money. You say right now earning season. Okay, earning season means you do not know what's could it be earning good, not good. You do not know. So you're betting on both ways, right? So you can betting on long call and long put. Okay, long call, long put. So you pay $2. This is also $2. You pay $2 by call. You pay $2 by put. Okay. So now you can see your profile on your make money will be like this. See? Okay. So basically you're just betting on this one. So you only pay this double $4, but the stock can be, if the stock going up, you make money. Okay, let me use this one. Sorry. Use this one. Okay. If stock going upward, you make money. Start going down, you make money. So you bet on the no direction, but volatility, because earnings season normally volatility will be high. So either way, you make money. But however, cost you very big. Here's the cost you. Okay. So if the big swing, if the earning report is how the volatility going up, right? So if going up, that's even lose the earning good, not good, or whatever. If down a lot, this is a lot of money. You don't even care here anymore because you cost you only $4, you know, all right? And then this is a big deal. But the problem is you bet on the volatility. So that's why the people say volatility was very, very important, okay? Now, like one more time since I'm here, okay? So you can bet in that way. Remember, this market, you can do anything you want to. If you're smart, you can do anything you want to, okay? So then you do what? You say very expensive, right? So I'm not betting that one, I'm betting the other guy. So I betting this guy. So I do this way. I sell the put and I selling the call, right? You're selling put, you're selling, selling the call, okay? So this $4 is yours until to maturity moment. So if matured by the time, let's say next week matured, this $4 is mine because I selling call, selling put, I double. And then what happened? They never touched this strike price. So never swing. This is volatility very, very low. Didn't go there level. So that means I save by maturity. So you can do any way you want. This is market. It's free. You do whatever you want, whatever you can. But however, this is the option. Option because selling, they have premium. So that's why people play premium. You can do both.
Professor, what's the difference between buying a call and selling a put?
What's the difference? Oh, buying the call, you pay, right? Let's go back to the chart again, okay? So the profit file is the same logic. So let me erase this piece, okay? But you get the money. The other ones you don't pay the money, okay? So let's say you buy the call, okay? You're betting direction is the same thing. You're betting the direction, same thing, but your way the betting is you don't pay it. So buy the call, you're betting on the stock going upward, okay? So you're gonna make a lot of money. But if you're selling the put, you're also betting on, so the put is selling here, see? This is your selling, see this is your profit, and then you downward, gonna be down a lot. So selling the put, see? So you bet call is going upward, is call also betting on this. You similar direction betting, but however, you're selling the put is you keep this money, you don't use your money, right? You immediately have this money in your account right now, all right? But you're betting on same direction. But however, you're going down a lot. But then you buy call, if up, you make a lot of money. This is infinity, okay? This is infinity. But you have time limit, okay? This is infinity. But you are forever stay this level, you're selling. But it's direction-wise, it's the same thing, okay? You divide direction, similar direction there, okay? So, All right, it's okay now?
What about for selling a put?
What do you mean? You're selling a put? Here you're selling a put, right?
No, that was for buying a put.
No, you're buying put is here.
Oh, sorry. I meant, what about for buying a put?
Buying put is here. You're buying put is here. Buying put, you're betting on down, you pay the money, right? You're betting on the stock going down. See, when stock going lower, you make a lot of money. Okay, so that's how you're betting on a direction. The put you bearish, right? Put normally you use hedging bearish. You're betting stock going down. Imagine that imagine. Let me erase out everything.
Oh, Professor. Another thing is the theta is different. The time.
Yeah, you got your gamma data always changed. Yes, you always change. That's why you need to monitor all those Greek, because your data, people data hedging, you keep changing it. You have to keep monitoring about adjustment. If you are, like I say, you balance the position, you have to adjust all the times, right? So you have to do that. So that's why your Greek, those letters keep changing any moment, anytime. You keep if dynamic hedging, you have to keep adjust the position, right? So
wait, so Professor, what if you're trading and you're trading options and you have both legs, the short and the long, but one of the legs are called, they decide to exercise, then what happens?
Then you just, I said, the other legs, if you have one leg, call it, yes. You didn't, you have many legs, like I said, like this one, you long call, long put, right? So you have right to do it. This is okay, you control it. But if you are selling it, let's say this put, you're selling the put, the guys who buy the put, they exercise earlier, you have to comply. Your broker totally clear your position and you got lost. Definitely it's not in your favor, because in this guy's favor. So you're going to be suffering. Yes, because you don't have a right. You have obligation. All right. So, okay. So you see this put to the stock going upward. You buy this put, pay the money, you're betting on going down, or you protect it. If you protect means you have stock, for example, your stock profile would be like this, right? So you start going upward, you make money, right? If you start going downward, you lose money. So this is your share, okay? You buy put, see, when stock going down, you lose money, but you put make money, so you end the result. That's why it's hedging is flat, okay? Depending on which position get in, so you don't lose money. That's how it is hedging is, the use put. Okay, so pretty much a lot. Options you need a whole semester. Okay, this just give you some flavor, some idea. But if you have questions, you have a lot of questions on this piece. Okay, we'll talk more. So option pretty much there already. So next time just clean up about the rest of the chapters. Okay, any other questions?